Trump's new tariffs are shaking up the world, and the U.S. Fed is staying put on interest rates. Now, central banks across Asia are asking, do we keep following America's lead, or do we do what's best for our own economies? Here in the Philippines, that's a big deal. For years, the Bangko Sentral ng Pilipinas has moved in step with the Fed to keep the peso stable and investors calm. But with inflation cooling and growth slowing, many say it's time to cut rates on our own terms. To break it down, we're joined by one of the most trusted voices in fixed income, Dino Aquino, Vice President and the Head of Fixed Income at Security Bank. Dino, good to have you back on Business
Hey, good morning.
360.
Good morning. Thanks for having me again.
Okay, let's talk about this. A lot of people are talking about decoupling. It's not new. Some countries have been doing it for years.
Yeah.
Some were never in sync with the U.S. in that regard. But what does it actually mean in central bank terms?
In central bank terms, it means we're moving. The U.S. is basically the benchmark of everyone. So in central bank terms, we're moving on our own merits. So we're not really that dependent on the U.S. when it comes to our policy movements.
Mm-hmm. When it comes to those policy movements, what is decoupling from the U.S.? What might that look like in practice?
In practice, probably around the spread of 50 basis points, because I don't see a scenario where we're in lockstep in terms of policy rates versus the Fed, because that's going to be too risky for our currency.
Never flat.
Yeah, never flat.
Never
so
flat.
Probably 50 basis points is the decoupling already for me in terms of
and
spread.
Talk to us about the risk of going in lockstep, of going flat. Why is that risky? How would that affect inflation? How would that affect us?
It could affect us negatively.
The peso.
Yeah, the peso definitely would weaken and would eventually push inflation higher. So that would also push interest rates in the secondary market higher instead of lower.
Lower rates, weaker currency, as we see with the U.S. and with us. When you say the BSP do you think the BSP has already started to decouple? We're at, our current spread is what, 75 basis points?
Yeah, which is in line with the comfort zone. You have to ask three questions. First question, are we capable of decoupling? So that's the first question. If you ask me, we are already capable of decoupling. First and foremost, if you just look at the two important factors that we look at, growth and inflation. The U.S. inflation rate is stubbornly still above 2%, which is their mandate. It's 2%, it's around 2.6 on the average. Ours is below our average of 2 to 4% targets. It's around 1.8 on a year-to-date basis. Growth-wise, they're also on a negative first quarter, while ours, though it's quite weaker than expected, is still around above 5%. So it's still very much respectable. So in those two factors alone, we have already decoupled from the U.S. Policy rates, we haven't. So if you ask me if they're capable, yes, we are capable of
Really?
decoupling.
Even though the U.S., even though the Philippines is one of those highly dollar-dependent countries, 41% of our OFWs come from the U.S. We can really do this?
I believe so, we can. The most important question is, should we?
Should we, and how do we do it? Should we? Do you think? What do you think are the biggest concerns right now? Is it more important that we keep rates low to support growth? Is it about preserving financial stability and market confidence? What do we need most at this junction?
Top of mind is growth. It's really growth. Recently, Secretary Recto revised our growth forecast lower to until the low end of 5.5%. Last year, we missed our target. Around 5.6 was the average. And this year, given that it's an election year, it's really important that we at least hit close to 6% average for the year. So primarily, I think growth is the most important factor.
That's right. Secretary Recto made a downward revision to our growth forecast from 6 to 8 to 5.5 to 6.5%. What's your house view at Security Bank?
Our house view is 5.9, so it's still below the 6% level. Yeah.
Okay. What does this say about the case now for decoupling?
For me, if you ask me, if you really want to decouple based on your own merits, you should decouple it properly. Meaning, you cut rates because you can, and not cut rates because you need to. So if you cut rates because you can, like I said, we're capable of doing so.
But right now, where are we? We can and we need to? Which one is it? Kind of like both.
The need is still not clear. So we have forecast. The BSP has to forecast this properly. They have to look at it from a long-term perspective. So if we cut rates now, will it be good on the long run. So, but if we wait for, like, for example, if growth suddenly drops significantly and then we chase and we cut rates, then that's the need part. So that's gonna create some volatility and uncertainty in the markets.
What's your house view on interest rates for this year? We saw in the earlier report, Citi expects two more rate cuts this year, and one more possibly in February. All 25 basis point cuts. The BSP has also hinted of two more rate cuts this year. What's the house view? Your house view at Security Bank?
Our house view is one more for the BSP and the Fed to cut twice. So to maintain that 75 basis point spread still.
Is there a point where decoupling could get too risky? What would be that point?
Yeah, we're in a bind right there. It becomes too risky if we chase. So meaning, for example, as I mentioned, if growth suddenly drops significantly, and then we chase by cutting interest rates 50 bips in one go. So that could create a lot of uncertainty, especially to the currency. So that would be very risky on our end.
Dino, you're head of fixed income for Security Bank. What reforms do we need from the bond market in order to help the BSP act more independently?
I think in terms of communication, the BTR has been communicating it very well. They mentioned that they will probably issue RTBs this quarter. So it's very well communicated. So I think in terms of preparation, the market is very much prepared for it. So once that comes out, I don't think it would deter the market from moving lower.
And from a fixed income perspective, what happens to the local bond market if the BSP cuts while the Fed stays put?
I think generally yields will still move lower. If you look at the policy rates right now, the historical spread between the 10-year, the Philippine 10-year and your policy rates is around 60 to 70 basis points. Right now, it's around 100. So we're widened significantly. There were instances where there were actually instances where the 10-year is actually lower than the policy rates during a bull market run. So if you ask me, the current nominal yields where we are right now is still quite high. So that's creating a lot of slowdown in terms of growth, especially on the property sector and even credit card debt, right? So all those things are really important for us to navigate. So we have to keep nominal rates at the proper level.
In related to that, can you walk us through what decoupling from the Fed might mean, how that might impact Filipino businesses and the average Juan de la Cruz?
It would impact us positively. It's like, for example, if we say we maintain a 50 basis point spread versus the Fed in terms of policy rates, I don't think the peso would weaken quite significantly, because if you look at the year-to-date performance of the dollar, it's quite weak. So that would be supportive of the peso. So that would keep investors calm, and it also would keep the average guy from borrowing, taking on a loan because rates are lower. So it would help us a lot.
Okay, beyond short-term moves, why would this decoupling be good for the Philippines, for the peso, for our long-term growth path?
It just shows that we are not dependent on the U.S. If you just compare the countries, the two countries, we're on a very solid footing compared to the U.S. The U.S. there's a lot of noise.
Right?
There's a lot of noise going on in the U.S. But in our case,
it wasn't like that in the past. Not to this extent.
Yeah, not to
this extent. Which is why it's causing this big rethink in strategy.
The Trump 2.0 is more volatile than Trump the first term, so it's creating a lot of chaos.
Yeah, you were telling me earlier about TACO, which stands for Trump always chickens out.
He just did again.
He rocks the boat, and then it's a crazy world, and it's difficult to navigate. But thank you so much, Dino, for sharing your views on this.
Thank you again. Thanks for having me again.